OptionChampion.com.
Today is Friday, July 22nd. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade on this Friday as we close out a very busy week that was full of earnings releases from big name companies such as Bank of America, IBM, Goldman Sachs, Netflix, and Tesla, just to name a few. Weekly jobless claims were also released on Thursday, coming in at 251,000, up 7,000 from the previous week and exceeding the estimate of 240,000. Despite a very news-heavy week, the cash market indices posted strong gains. The Dow gained 611 points on the week, the S&P 500 gained 99, the Nasdaq Composite gained 382, the Russell gained 62.5, and the VIX ended the week lower by $1.20. Crude oil gained 61 cents on the week, gold gained $18.80, silver lost 17 cents, and natural gas finished the week higher by $1.14. Well, as earnings come pouring in, I had to make an earnings trade this week, and I did just that, in ExxonMobil, symbol XOM. Exxon is expected to report second quarter earnings next Friday, July 29th, before market open, and I wanted to get in on the action. The average earnings estimate is $3.74 per share, compared to $1.10 per share in the same period a year ago. The company has earned a total net income of $6.03 per share over the last 4 consecutive quarters. As of my technical analysis on Tuesday the 19th, Exxon stock was priced at $88.27 per share. That was 16% off of its one-year high, 3% below its 50-day moving average, and 14% above its 200-day moving average. Over the previous 50 trading days, the average price change was $1.94, with an average price range of $3.39 and max price range of $7.67. Because Exxon is a profitable company, I decided to make a bullish play on the stock, meaning I have a positive outlook on the stock, an expectation that the stock price will respond positively to the earnings release. So that meant selling a put. For some quick options 101, a put option controls the selling of shares of the underlying stock at an agreed upon price, the strike price, on or before a future date, the expiration date of the option. The buyer of the put option has the right but not the obligation to sell shares of the stock at the strike price if the stock price falls below that strike on or before the expiration date. The seller of that put option is then obligated to acquire shares of the stock at that strike price, regardless of where the stock is priced in the open market, unless the seller closes the option or moves it to a later expiration date, either at the same strike price or a different strike price. A put option gains value as the underlying stock price falls and loses value as the underlying stock price rises. As I mentioned a moment ago, the stock had a 50-day average price range of $7.67, so knowing that the stock could potentially decline up to $8 from its price of $88.27, I chose an $80 strike price. On Wednesday the 20th, I sold an 80 put in the September 16th expiration cycle, which was 58 days away. The market was $2.37 bid, offered at $2.52, putting the mid price at $2.45. I offered $2.50 and was filled. Option contracts represent 100 shares of stock, so that was a $250 credit that I received on the sale. Because I'm short the put option at the $80 strike, I want the underlying stock price to remain above that $80 strike price. If the stock price falls below the $80 strike, I will be at risk of acquiring shares of Exxon stock at $80 per share. Depending on how much time is left until expiration, if the stock price falls below the $80 strike price, I will either hold on to the option and see if the stock price rises back above the $80 strike, or roll the option to a later expiration date, either at the same strike price or a different strike price. My max profit is the $250 credit that I received on the trade, and my max loss is the $80 per share strike price if I ended up owning the stock at $80 per share. But in the options world, we say there's an undefined risk because the stock price can fall anywhere between 80 and 0. And there's no way of knowing how far the stock would actually fall. My objective here, however, is for the stock price to rise or at least stay above the $80 strike before the put option expires, so that the option will lose value and I can buy it back early and take profits. Next week's Tricks of the Trade will kick off a series beginning with the basics, where I cover what options are, the types of options and how they're used, followed by a deep dive into the building blocks of trade analysis and setups, where I cover the various metrics such as 50-day average net change, average price range, and max price range, and how they're used in deciding on a trading strategy. All of that begins next week. That does it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.